Many people load up on pre-tax accounts like a traditional IRA and a 401k thinking they're going to pay lower income taxes in retirement because they're going to spend less. But here's the reality. What day of the week do you spend the most now? Golfing, shopping, dining out, it's Saturdays. In retirement, every day is now a Saturday, so in my experience, spending often stays the same or even increases once you retire. Tax rates might even rise in the future, making Roth IRA dollars even more powerful. But let's assume the rates stay the same for the sake of our conversation today. At the age of 73, the IRS forces required minimum distributions, or RMDs, from pre-tax accounts. Think of your IRAs, 401ks, TSPs, 403bs, all those combined. The percentage starts around 3.8% and climbs steadily. So if we take a look at someone that has $500,000 in pre-tax dollars, and they're 13 years away from RMD age. They're 60 years old, 13 years away from 73. And we're assuming an 8% growth rate, and they're not going to pull out of these accounts until they're required to. So over that 13 years, that $500,000 turns into $1.3 million, and RMDs begin. Around 51,000 at first. If once they get to age 85, if they continue to earn that 8%, it's 125,000. And if we look at age 95, $221,000 a year in required minimum distributions that you're also required to pay taxes on. So the question is that going to jump you into higher tax brackets? I believe it probably will. These forced withdrawals happen whether you need the cash or you don't need the cash, pushing you into higher tax brackets and making more of your Social Security become taxable. So what's the Roth advantage? Your Roth IRA has no RMDs during your lifetime. Money grows tax-free, it comes out tax-free, and there's no forced distributions to disrupt your plan. I'm not saying go all Roth. Pre-tax dollars still have value, but without planning, RMDs can derail your retirement by spiking your taxes. The solution is a balance of Roth and pre-tax contributions while you're still contributing, possibly strategic Roth contributions before you turn 73. You can do planned qualified charitable distributions to avoid taxation on your RMDs, or a tax-efficient withdrawal strategy to avoid jumping into higher tax brackets. Either way, having a plan can help you limit future taxation and allow your dollars to last longer in retirement.